Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The best traders in the world, they'll be the first people to tell you that they can't predict the market. That's not what we're trying to accomplish as a trader. What we're trying to accomplish is putting on a smart trade that has a statistical likelihood of being a winner in the long run and then managing our position properly. So that almost always starts out with analyzing the technicals. And we look at a chart like this. This is a simple candlestick price chart of the EUI. And okay, so we can kind of see, it's fallen fairly substantially, really, over the past since April. And it's really come down below its moving averages. And you could kind of take a look at this and see that the candlesticks themselves aren't as big as they used to be. And, from wick to wick here, it's not as big as it used to be. And from day to day, the candlesticks are, they're kind of closer together. So what we can observe here is that there's a little bit less volatility than we used to be seeing. But it's kind of hard to quantify that, really. I'm saying, okay, well, the wick to wick, it's less and blah, blah, blah. But how much less volatile is it? Well, here's what you need. You need to take a look at a volatility chart. Now, these charts that I'm using here, they're from a source called LiveVol. And their software is pretty good. I've been taking a look at it lately. I don't work for them or anything. I'm just, commenting objectively. And it can really help you analyze volatility. Now, there are some other sources out there. And a simple Google search will allow you to find some of them. And some of them are free, and some of them you would pay for. Now, what we're looking at here is your classic 6-month volatility chart. And there are two lines. The first line that we'll talk about is the red line, which is implied volatility. The second line that we can observe here is this sort of grayish, or maybe that's, kind of periwinkle, I'd say. The periwinkle line is realized volatility, or historical volatility. And if you look at the top, there's IV30 and HV30 that are in white, if you can kind of see that. Maybe I can use a highlighter here to circle that. Oh, well, I probably ought to use a better color here, huh? Hold on a second. Ah, there we go. Okay, well, you can kind of see that, the black screen. Anyway, IV30 is the implied volatility for a 30-day option, and HV is the historical volatility for a 30-day option. Now, let's take a little minute here and deviate and talk about what each of those things means. Historical volatility is just simply what I was just talking about a minute ago when we were looking at the candlesticks. It is a measure of exactly how volatile the price of the currency has been over the last 30 days. And we do that mathematically by looking at the standard deviation. Standard deviation is sort of a fancy mathematical term to talk about how big the price fluctuations have been over a certain period of time. Now, in this case, it's 30 days. But if we were looking at the 90-day historical volatility, or the 60-day historical volatility, or the 10-day, or what have you, we want to be able to kind of compare apples to apples. So what we do in practice as option traders who study volatility is we annualize the volatility. So this is the 30-day standard deviation, but we take it and annualize it to make it represent a full year. So that 30 days represents a full year. So that's what the blue line represents, and as you can see, it's just what you would expect from when I was talking about the candlestick chart. Since April, the EUI has gotten significantly less volatile, and we can measure that. In April, the historical volatility was up close to about 18%, and now it's down to about 7%. And you can also observe these numbers not just in terms of a chart, but you can see them up here as well. Now the red line is the implied volatility. Now the implied volatility is the volatility component that's embedded in option prices. It's basically looked at as the market's estimates for the future volatility of EUI. And that volatility is implied by the market prices. The higher the implied volatility, the more expensive the options, and the lower the implied volatility, the cheaper the options. Now, as you can see here, the implied volatility is significantly over the historical volatility. And, you know, you can kind of see a lot of that going on in the market. You can see that in stocks as well, not just currencies. All right. So let's kind of go through an example here, and then we'll kind of backtrack and give some supporting reasons why we might do this. With EUI at $68.12, I'm going to buy 1 December, which in this example is a 73-day option, 68 strike call at $1.50. And I'm going to sell 1 November 45-day 68 strike call at 108. So, okay, I'm buying the option that has more time until expiration, and so certainly that option will be worth more. Options that have more time until expiration are worth more than options that have less time until expiration. So the moral of the story is this spread is established for a net debit. So I'm going to pay 42 cents to put this trade on. Now, there's a couple of different ways to look at this trade, and those same two ways can be used to look at any option trade. And the first one is with absolute risk. And absolute risk is usually observed by use of a P&L diagram. Now, as Steve said, you know, I wrote a book on trading option Greeks. That happens to be the title of the book. And I'm a big proponent of all traders, not just professional traders, looking at the Greeks. And there's a reason for that. And this is a quintessential example of that reason. P&L diagrams are limited. They have limited use for you. Now, if we're talking about a covered call or a long call, we can draw a nice, simple, kinked diagram that illustrates here's my maximum loss and here's my maximum profit potential at each strike price. And it's relatively easy to see these things.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.